What if you could set up your money in a way that it actually pays you every month on autopilot, like a paycheck that shows up whether you're working, sleeping, or on vacation? Sounds insane, right? I used to think the same thing until I realized I wasn't really chasing wealth. I was chasing freedom from financial anxiety. That low-key stress of knowing everything in your life depends on one paycheck. Rent, groceries, insurance, everything. A couple years ago, I was doing okay. I had savings, a job I didn't hate. But then life did what it always does. I got hit with two surprise expenses in the same month. One car issue, one medical bill. I was drained, financially and mentally. And that's when it clicked. I didn't need to make $1 million. I needed my money to start working like I do. Monthly, reliably, and with zero drama. That's what led me down the rabbit hole of dividend ETFs. And not the hypey stuff you see in flashy thumbnails. Real research, real math, real strategy. In this video, I'm going to show you exactly how I built a portfolio that now sends me dividend deposits every month, and how you can start building your own version with as little as $1,000. No stock picking, no 40-year waiting game, and definitely no crypto moonshots. Just a smart, scalable way to build perpetual cash flow. But before you go thinking it's too good to be true, I'll also show you the risks, the myths, and the biggest mistakes most people make when chasing yield. Stick around to the end, and I'll even break down the exact mix I'd use if I were starting from scratch today. This is Dividend Hustle. I'm Mark, and this is the blueprint I wish I had 10 years ago. Let me tell you what woke me up about money. Let me take you back to a Tuesday afternoon that nearly broke me. Rent was due, my brakes were shot, and I had a dentist bill I'd been ignoring for 2 weeks. My paycheck had landed 5 days earlier and was already gone. I wasn't living recklessly. I wasn't out popping bottles. But somehow, I was always just one unexpected expense away from stress, scrambling, and sometimes swiping credit cards just to get through the month. And that's when it hit me. This wasn't a budgeting issue, it was a cash flow issue. I had savings. I even had some money in stocks, but none of it was helping me in that moment. Nothing was flowing to me. Everything I owned required me to wait. Wait for appreciation. Wait for the market to go up. Wait for someday. And I realized I don't want to just build wealth on paper. I want my portfolio to actually pay me in real life every single month. That was the moment I stopped asking, how big is my net worth? And started asking, how many income streams do I control? Because let me tell you, there's a world of difference between having $100,000 in your account and having $500 coming in automatically every month. One looks good on a screen. The other puts food on the table without you lifting a finger. Here's the truth about dividend investing. Nobody tells you. Let's clear something up right now. You don't need $1 million to build meaningful passive income. That's Wall Street's favorite lie. Make it seem impossible so you don't even try. Most people follow the same tired blueprint. Work 40 years, stuff money into a 401k, and hope your retirement accounts spit out enough in your 60s to cover the basics. That plan used to work, but rent, food, and everything else, have you seen prices lately? Waiting 4 decades to feel financially free is the slowest, riskiest plan out there. Now, let me be real. Dividend investing sounds sexy, especially when you hear words like passive income and monthly checks. But here's the reality. Most people try it the wrong way. They chase high-yield stocks they don't understand. They hear about a 10% yield and throw money in, only to watch the company slash its dividend 6 months later. Rinse, repeat, burnout. That's not investing. That's gambling with a spreadsheet. The truth is, not all dividends are created equal. And monthly payouts don't automatically mean better returns or lower risk. You've got to look under the hood. What strategy is the fund using? What companies are inside it? Are they doing something smart with options or just juicing numbers to look good on paper? Dividend income isn't magic, but when done right, it becomes the most predictable, sustainable, and sleep well at night strategy I've ever used. And in the next chapter, I'll show you the simple framework that changed everything for me and helped me finally stop guessing. All right, let me show you the simple system I built for myself. After I stopped chasing random dividend stocks and started thinking like a system builder, I created what I now call the Freedom Framework. It's 3 simple pillars: lean, coast, barista. This changed everything for me. It's not about hyper complexity, it's about clarity. And once you get this, you can design your own income engine based on your lifestyle and risk comfort. Let's break it down. Lean is your foundation. These are low-fee, quality-first ETFs that prioritize dividend growth and long-term strength. Think of this as the spine of your portfolio, the part you can count on through recessions, inflation, whatever the market throws your way. Coast is the balance point. These ETFs give you a mix of current yield and capital growth. Not too risky, not too conservative. If lean is your core, Coast is the engine that moves you forward without shaking the boat. Barista is your cash flow workhorse. These are higher yield ETFs, usually using covered calls, that prioritize monthly income today over long-term growth. It's not about getting rich quick. It's about rent, groceries, gas, the essentials covered by smart ETF strategies. Each one has a job. Each one comes with trade-offs. But together, they form a portfolio that blends resilience, yield, and real-life utility. And the beauty is, you can sketch your own mix. Maybe you want 60% lean, 30% Coast, and 10% Barista. Or maybe you're more income-focused with a 40-20-40 mix. There's no one-size-fits-all answer, only the one that fits your risk profile, goals, and timeline. This isn't theory. This is the model that took my dividends from barely noticeable to covering bills in the under 2 years. And it's what I'd use again if I had to start from zero. Now here's why I stopped buying individual stocks completely. Now here's where most beginners trip up, because I did too. At first I thought, why not just buy the highest paying dividend stock and call it a day? Sounds smart. Until that one company cuts its dividend, and suddenly your income stream vanishes overnight. That's why I stopped picking individual dividend stocks and moved to ETFs, specifically dividend-focused ETFs. Why? One word: diversification. When you buy a single stock, you're betting on one company. When you buy an ETF, you're getting a whole basket of companies, sometimes dozens, sometimes hundreds, all managed and rebalanced for you. So if one company stumbles, it barely moves the needle. And here's where it gets interesting. Some of the most powerful dividend ETFs don't just hold stocks. They also use covered calls, a strategy that allows the fund to generate extra income by selling options on the stocks they already own. Think of it like renting out your house's attic. You're not selling the house, you're just earning cash from space you weren't using. But like anything with upside, there are trade-offs. Covered call ETFs usually have higher yields, often in the 7 to 12% range. But they often cap your upside during big market runs, because those call options limit how much the ETF benefits from rapid growth. They also tend to have higher fees than basic index funds, which can eat into long-term performance if you're not careful. That's why in my portfolio, I blend income-heavy covered call ETFs with low-fee long-term dividend growers. It's not about chasing the highest yield. It's about building a system that keeps paying through the ups and downs. When I started treating my portfolio like a business, not a lottery ticket, everything changed. And in the next chapter, I'll show you exactly how to structure your mix so you can create the kind of monthly income that actually shows up when you need it. Let's build this thing together. I'll walk you through it. So, how do you actually build this thing? Let me walk you through 3 real portfolio examples based on different goals and risk appetites. These aren't guesses. They're based on what I've tested, researched, and refined. Portfolio 1, the foundation first approach, low risk, long-term focus. This one's for the builder who's thinking ahead. Maybe you're in your 30s or 40s and you care more about security and slow compounding than hitting big income numbers right away. 60% SCHD, low fee, dividend growth focused, proven long-term performance. 30% VOO or SPY, broad market exposure with capital appreciation potential. 10% JEPI or GPIX, just enough high-yield income to keep the snowball rolling. This portfolio prioritizes stability and growth, with a small slice of income to keep it engaging. Portfolio 2, the balanced cash flow blend, mid-risk, mid-yield. This one's ideal for someone in their 40s or 50s, or just anyone who wants to blend monthly income with long-term resilience. 40% SCHD, foundation of quality dividend growth. 30% JEPI or GPIX, covered call ETF for monthly income. 20% QYLD or GPIQ, higher yield, more aggressive income play. 10% VTI or VUG, just a pinch of growth equity for balance. This mix creates a portfolio with a 6 to 7% average yield, monthly payouts, and upside potential. Portfolio 3, the income first hustler, aggressive, high yield. Let's say you're laser focused on income now. Maybe you're semi-retired, or maybe you just want your investments to start pulling more weight today. 35% JEPI, consistent monthly income with blue chip exposure. 35% GPIQ or QYLD, higher yield covered call fund focused on tech. 20% YLD or PFFD, additional high income sector exposure. 10% SCHD, still keep a slice of quality to prevent drift. This one's pushing for 7 to 9% yield, but it comes with more volatility and potential upside capping. The key is knowing what trade-off you're comfortable with. None of these portfolios are one size fits all, but the framework stays the same. You choose your mix of lean, coast, and barista, then let the machine do its job. Want to know when the cash actually shows up? Here's where things get real. It's one thing to talk yield. It's another to see actual money hitting your account on a schedule. The beauty of this strategy is predictability. Most covered call ETFs pay monthly, and some even do it on set dates. JEPI and JEPQ, usually around the 4th of the month. GPIQ or QYLD, often between the 8th and 10th. SCHD pays quarterly, often toward the end of the month. That means if you've got the right mix, you could be seeing income land 4 times a month, spaced across the calendar. Not just quarterly surprises, monthly rhythm. But here's the real power move. Reinvest those dividends. It's called DRIP, Dividend Reinvestment Plan, and it's how compounding works quietly in the background. Every payout buys you more shares. More shares lead to bigger payouts. Bigger payouts buy even more shares. It's the dividend flywheel, and once it starts, it accelerates faster than most people expect. Let's say you start with $10,000 in a mix that yields 7%. That's $700 your first year, but reinvest that, it's closer to $750 the next. Then $805, then $860. It snowballs, and that's assuming zero price growth. So forget the fantasy of overnight millions. This is how you build a reliable compounding income stream that starts small but never stops. Quick warning, here's where most people mess this up. Let's talk about what trips people up, because it's not just about picking the right ETFs. It's also about avoiding the silent killers. First up, fees. Now, most dividend ETFs have pretty reasonable expense ratios, but if you're not paying attention, you could be bleeding returns without realizing it. For example, if you're earning 8% but paying a 1% fee, you're actually giving away 12.5% of your income every single year. That adds up fast, especially when compounding should be working for you, not against you. That's why I lean toward ETFs with 0.3% or lower expense ratios for most of my mix. There's nothing flashy about a low fee, but it's one of the easiest wins you can lock in forever. Then there's the yield trap. This one gets a lot of people, including me when I first started. You see a 12% yield and think, wow, that's free money. But often those funds are using aggressive strategies that eat away at your principal, or they're full of assets that are under serious pressure. High yield doesn't always mean high quality. Sometimes it's just a red flag with lipstick. And finally, the biggest risk, you. More specifically, your emotions. Markets dip, headlines get scary, and suddenly the ETF you loved when it was paying monthly now feels too risky. That's how people sabotage years of progress. They sell low, swear off investing, and miss the rebound. That's why I built my portfolio with a structure I can stick to. Not just in bull markets, but in rough ones too. Because while the panic seller is locking in losses, the patient builder is collecting dividends, reinvesting quietly and coming out stronger every single time. This isn't just about numbers. It's about behavior. And behavior is what separates the folks who dream about financial freedom from the ones who actually reach it. Let me show you how to start, no matter your budget. Now, maybe you're wondering, okay, Mark, this all sounds great, but I don't have $50,000 lying around. Where do I even start? Simple answer, right where you are. Let's break it down. $1,000 portfolio. Start with 2 to 3 ETFs max. Go with something like $600 in SCHD for long-term dividend growth, $400 in JEPI for monthly income. Set up DRIP and let it roll. You won't get rich overnight, but you'll get your first dividend within 30 to 45 days. And that's the spark that starts the snowball. $5,000 portfolio. Now we've got room for a bit more balance. You could try $2,000 in SCHD, $1,500 in JEPI, $1,500 in QYLD or GPIQ for higher income. This mix gives you both growth and monthly cash flow. Set it, DRIP it, and check in once a quarter. $20,000 portfolio. This is where the machine starts to hum. You can go full freedom framework, $8,000 in lean, SCHD VIG, $6,000 in coast, JEPI, GPIX, $6,000 in barista, GPIQ, QYLD. At this size, you're looking at $100 to $150 per month in dividend income without lifting a finger. But here's the real key. Automation, not perfection. You don't need to time the market. You don't need to get every allocation right on day one. You just need to start. Because every month you wait, that's a dividend you'll never collect. This is a long game, but it starts fast if you let it. I've got one last thing I need to say before you go. I'll be honest with you, when I started this journey, it felt small. My first dividend payment was something like $4.82. I laughed at it. It felt like a joke. But then month 2 came, then month 3. And after 12 months of staying consistent, reinvesting, tuning the portfolio, and avoiding emotional decisions, something shifted. By month 18, I wasn't laughing anymore. My portfolio had grown faster than I expected, and my monthly income had doubled, without me adding a single extra dollar after the initial investment. That's the quiet power of compounding when you get out of your own way. And now, it's not about how much I earn. It's about the peace of mind, the confidence that no matter what happens with my job or the economy or the headlines, I have cash flow that shows up automatically. That's not hype. That's freedom. So here's my question to you. What's your lean coast barista mix? Drop it in the comments. Let's talk strategy. Let's share ideas. And let's stop pretending like financial freedom has to wait until you're 65. If you're serious about this, here's your next step. If you're ready to build your own dividend machine, I've put together a simple, free one-page PDF that outlines the full freedom framework, sample ETF mixes, goal-setting prompts, and tips for automating your first $1,000. You can grab it in the link below. No paywall, just value. And remember this, every month you wait is one less dividend you'll ever collect. You don't need to be perfect. You just need to start. Start small. Think long. Hustle smart. This is Dividend Hustle, and I'm Mark. Let's build something that pays you forever.